I think this is FM.
Yes, please.
This is FM. Okay. So
Yes, please.
you said you have treated like 3 to 4 topics.
Yes, sir.
So cost of capital.
You can check our YouTube.
Oh, okay. Okay, no
If you
problem.
check YouTube, just go to playlists.
Okay. Okay, thank you.
Yeah, thank you. Tolulope, please, you can just please can you assist me with something? Please, can you just copy the playlist link and send to the platform, please?
All right, sir.
Thank you. Just a minute. We are about to start the lecture. Please, if your friend is not here, you can just test his or her. Can just like if na guy, call him. If na lady, call her. That we're about to start. No be say they call me.
Topic go talk.
No be say make you call and come dey chat, come dey do chat to leave that one after class. Okay, leave that one after class. So any other thing, what is most important is just the call.
Cynthia, please, we want to start class now. Don't disturb me, please. So, please. So,
Ah, see this man. You're
So I'm
own.
new now.
You are new. No, you are not new now.
Yes.
Silas now. You
I'm
joined my
I'm
last
not
class.
introduced myself.
Oh yeah, now introduce yourself quickly. We want to start lecture, please.
Okay, my name is Silas. I'm from River State. I'm single. I'm also looking for who to mingle with. Thank you, class.
That is not introduction. Whether you are single or you are not single, is not even part of the introduction. I'm sorry about that. Right, it's supposed to say your name and your location, okay? But that's fine. That's fine. That's fine. So, in today's class, good evening, distinguished professional colleagues. You're welcome to another edition of our lecture on financial management. In today's class, we shall look at another topic entirely, which is investment appraiser. You can actually call it capital budgeting or investment appraiser, whichever name you want to call it, right? Now, this investment appraiser class, let's know it covers 25% of the syllabus. 25% of the syllabus. Please, it is very important for you to pay attention here. The way you pay attention to cost of capital, please also pay attention to this topic as well. Very, very important. So as we are moving now, we'll make sure we touch everything under the 25%. Then we'll move to my favorites, which is no, not acquisition. What is it called? Valuation of a business, right? Valuation of a business, right? Valuation. So please pay attention, please. Okay. The question now is, what is capital budgeting, or what is investment appraiser? Class, you should not equally forget. Let me take you back a little bit. Under the function of a financial manager has a function for the function of a financial manager are the investment decision, the financing decision, the dividend decision. Any other decision can come, which is risk management. Now, as a financial manager, you please, if I don't tell you, if I didn't ask you to talk, please don't interrupt my class, please. Thank you. Now, as a financial manager, you have investment decision to make. You've identified a project that is viable, which is investment decision. Class. Investment what? Investment decision. Now the question now is, how will you source for this finance? If you want to finance this project, how will you finance this? That is what takes us to cost of capital. Then we are back in we are back to investment appraiser. That is, as a financial manager, you have a decision to make, right? By looking for a capital investment that will maximize the shareholders' wealth, right? And present to the managers, to the board. And that takes us to investment appraiser. Investment appraiser or capital budgeting is a function of a financial manager. It is for decision making. As a financial manager, you identify a project, right? A capital budgeting decision may be defined as the firm decision to invest its current fund most efficiently in a long-term asset with anticipation of an expected flow of benefits over a series of years. Class, you've identified the project, you have to fund it. You fund the project. Must be what? Efficiently in the long-term what? Asset. Now, as a financial manager, the investment decision of a firm, maybe it may not necessarily be a capital investment, but we'll be looking at, for the purpose of this class, we'll be looking at capital investment, capital projects that are capital in nature, that can last for a long period of time. So, which means as a financial manager, you can make an investment decision. Either they can decide to expand their business operation, probably they want to do acquisition, replacement. It's generally known as capital budgeting decision, right? It is generally known as what? Capital budgeting decision. It is mainly for investment decision, most especially when it is capital in nature, right? Oh, excuse me. Now, I haven't explained this. Class, are we still together, please? Are we still together?
Yes, sir.
We are together,
Yes,
sir.
sir.
Okay,
Yes, sir.
together. Okay, that's fine. That's fine. Now, the characteristics of features of investments. You make different investments, you have this, and my point, let's quickly move. What is capital budgeting, budget, and the importance of capital investment decision? A capital budget is a program of capital expenditure for the next few years, updated every year, setting out details of capital projects authorized, but not yet undertaken. Class. Most especially capital investment. Maybe you may see yourself as a financial planning analyst or as a project finance officer. You know, you have not executed the project, but you are predicting, you are projecting, you are making a projection that, okay, at the end of, who is that? Please, the person she meets is our mic. At the end of year 5, they should be able to have these so things, right? Because it is not yet to be what? To be undertaken. Is that not so? And those likely to occur in the next few years, but that have not been authorized. Class, you know, capital budget, as a project finance officer, you build up a model that, okay, this is the initial outlay, which is the equipment that will be used for this project at year 0. Because they will ask you question, when are we going to start making sales? It is when you complete the project. It is when you complete a project before you can be able to like be making a revenue from. Now you cannot be predicting that. Okay, let's say for instance, I work in before now. I used to work in a real estate firm, right? We are property managers, right? Then when I used to work in real estate, so in finance, you look at it that okay, this is three units of 3 bedroom. Okay, what is the cost? This is the cost. Okay, what is the expected cash flow from there? It has not occurred, but you are projecting for what will happen in order for you to maximize your shareholders' wealth. Class. If they are saying that you are maximizing a shareholders' wealth, okay, we'll get there. Now we also have the importance of capital investment decision. Can you see the importance? Capital investment decision is as important as anything, right? You can see the importance of this decision. We also have here the stages of capital budgeting or capital investments. Every capital project has a particular stage, so you can read it up when you get your material. My focus is not all these things, so all these things, the English too much. Now, the next thing is the classification of capital investment decision. When you want to make an investment decision, a capital means something that is a long-term period. It is not shares. It is not shares. So we are talking about capital house, or a project, a construction, something that can last for a very long period of time, right? We can classify the capital investment decision as expansion of existing business. You are producing rice. You can decide to expand the production, maybe to south or towards the northeast. Expansion of new business. Probably the first one is existing. You can make a decision, capital investment decision, based on the existing as well as the new. Then we have what we call replacement. Right? Replacement theory is part of what we cover under the investment appraisal. We'll get there. But my point here is, when you want to make a decision, capital investment decision, you can also make a replacement decision. Probably the assets that you're using, right? You want to like change it. You want to know when will you be changing? When will you be changing that particular asset? Is it every 2 years? It is part of capital investment decision. Then capital investment for maintenance of market position, for diversification, and all that. Now we also have a capital investment decision on what we call a mutually exclusive investment. It is still decision. It is still capital investment decision. Mutually exclusive investments are projects. Is a decision. Are projects which serves the same purpose and compete with one another. Meaning that choosing one choosing one entails rejecting it. Meaning that when I for my babies, I have Abigail, I have Abidemi or Tolulope. I can decide that the mutually exclusive, I can decide that okay, since they are still part of the babies, right? I can decide that okay, let me choose Tolulope or Abigail. Right? Are we getting? So that is a mutually exclusive, whereby you have to choose one and leave one because they serve the same purpose. Class, am I communicating, please? Now, we will see now part of the decision now. There's what we call independent. Class, I'm just explaining capital investment decision that you may see. right? It is beyond just passing the exam, right? Now, independent investment. There's what we call independent. You can make a capital investment decision on independent investment projects. These are projects independent. They don't depend on anything. They do not compete with any, as they have has no impact on other projects. They stand on its own. That these are independent investment decisions. They stand on their own. They are not related. Just like you are comparing, you have Abigail or you have Ibrahim. You can see it. We are not, we are not, you can't, because we are independent, right? You cannot compare these two together, right? Because independent means they can stand on their own, right? We'll get there. All these points are very important when we get to capital rationing, right? Now, dependent investments are projects performed together, and so the undertaking one entails undertaking the other, meaning that they are dependent. If you have 3 projects or you have 2 projects, that is dependent, because the question may say, if this one is mutually exclusive, if this is all those, they are grammar, all those things is just English. We'll get there. We'll break it down to the extent that even when you are sleeping, you understand capital investment appraisal, right? Everything under investment appraisal, right? Up to the replacement decision tree and all that. Now, dependent investment means that it depends on what another project, a project that depends on. If you undertake A project, you must undertake B. So in the question, it may be stated that, oh, this project is what? It's a dependent project. Therefore, calculate this. We'll get there. You can also make a capital investment decision on what we call divisible investment. These are terms. All these terms, right? All these terms are capital rationing terms, right? So, but it's still part of capital. It's still part of investment decision, capital investment decision. You can make it on divisible investment. And the question now is, what is divisible investment, or what is divisible project? A project that can be undertaken in parts, right? You can undertake it in part, meaning that Abigail have 50,000 naira, and Abigail need to execute a project worth 1 million. Now, Abigail can decide that, okay, what is the percentage of this 50,000 from this 1 million? Maybe it is 2%. Okay, let me just undertake 2 out of 2% out of 1 million. That is what we call divisible. Part of it can be what? Undertaking. We'll get there when we get to what? Capital rationing. Now, another thing you need to know is, under the capital investment decision, is indivisible project. The question now is, what is indivisible project? A project that cannot be undertaken in part. So there are some projects that if you don't want to take it in full. If you want to execute the project, execute it in full. If you don't want to execute it, just leave it. Right? These are what we call indivisible project. Right. Oh, and so on, like that, right? So we need to move to all these ones. You can read it, right? So we can move. Okay, now investment appraisal techniques. When you want to appraise a project, right, there are 2 techniques that you can use. There is the traditional approach as well as the modern techniques. Now, under the traditional approach, it is where we have the payback period and the accounting rate of return, or return on capital employed, whichever the case may be. Now, under the traditional approach, is a method of appraising a project which does not consider the time value of money. And they include the payback period and the accounting rate of return. It does not consider time. It does not consider the time value of money. They make use of, in fact, they don't even make use of accounting profit. They make use of accounting profits. They don't make use of cash flow. They make use of, accounting profit does not consider the time value of money. If you look at it, right, it doesn't. You don't know. It's not projecting that, okay, this is what you will have. Okay, what would be my present value? If I invest now, what will be my present value now? What is my present amount now? Maybe the project is for 3 years. What is my present this thing now? Doesn't consider it. The time value of money. We'll get there. Then, under the modern approach, right? That is they usually call it. You can call it a discounted cash flow techniques. You can use it to appraise a project. So, one, it is when we have the net present value that consider the time value of money, the internal rate of return, and the profitability index, right? And the what? And the profit. That is the part of capital rationalization, right? So we'll pick it one after the other. Today's class is just an introduction. I will explain. My own, you guys know my pattern now. I will explain to you to the extent that when you go back, it will flow. Is that not so? Now, let's just follow, because I think I have like 15 questions. There are questions you will solve. So let's just have the understanding of the topic first. Now, payback period. The question is, what is payback period? Payback period is a traditional approach in appraising a project, right? That payback period is the period at which it will take Abigail to recoup back its investment project. Capital. Class. I mean what? The time that it will take Abigail to recoup. Abigail, hope you will not what is it called? Am I free to use your name? Should I change?
Yeah, free, sir.
Okay, that's fine. That's fine. So don't mind me, Joe. I just wanted to look at names that I can use for proper understanding, right? So what I'm trying to explain here is the payback period, right? It is the time. Okay, it is payback period is the period at which you will use to recoup back your investment. What you invested in this capital investment, capital project, the time, these 3 years, these 6 years, and that is what payback period. Now, it is the period usually expressed in years, which take the cash inflow from the capital investment project to equally to the cash outflow, meaning that you invested 50,000. Of course, it will be your outflow, right? It will be your what? Outflow. Then you will now be doing what? It will be your outflow. Then you will now be what is it called? You will be like, when will you get back your investment? You'll be receiving some kind of inflow, cash inflow. Okay, maybe you invested 50,000. Okay, you collected in 1 year, you receive 5,000 naira from 50,000. Class, are we together? Out of 50,000 naira that you invested in first year, you receive 5,000 naira. It remaining 45,000. In the second year, you receive 5,000. It remaining 40,000. The time that we take you to recoup back that investment, it is what we call payback period, right? And what is the decision rule? The decision is, the shorter the period, right, the more it is actually better for you, for the investor, right? Accept the project if the payback period is less than the maximum, right? We have usually the shorter the period, the better it is. If the project lifespan is 5 years and you can recoup back your investment for 3 years, and that makes sense. It is even lower than the life of the what? The life of the project, right? So we have the advantages of cash, the payback period. So payback period did not make use of actually make use of accounting profit though. Sorry about that. It is accounting rate of return that make use of accounting what accounting profits, right? Now you can see that it's based on cash flow and not subjective profits, right? Now, class, the payback period, you see, after you have recouped back that your investment, immediately you recoup back that money. Any other cash flow is irrelevant. You don't need it because we want to just know the time at which you will recoup back your investment. It gives insight into the liquidity of the project and all that, so you can read all through the payback period. So it does not consider the time value of money, we know. So it does not consider the return on capital. It ignores cash flow after payback period. This is what I'm trying to explain here. It does not consider the time value of money. Immediately after you have recouped back your investment, it ignores all the cash. There's what we call discounted payback period, right? Where we have a discount. Of course, we'll look at a discounted payback period. This is the numbers of years taken to recoup, right? Where it does not consider the cash flow afterwards, but it considered the time value of money because it is discounted. It is discounted because it considers what the time value of money because it is discounted payback period. Of course, we'll look at that as well. Now, under the traditional approach, right? Please, you should not forget the decision under the payback period, right? You should not forget the decision under the what? Under the payback period. Now, accounting rate of return. This method is used. It is not based on cash flow. It is based on accounting profit, right? It is based on what? Accounting profit. So now, if the question says, oh, use the internal rate of return, accounting rate of return, sorry, right, to evaluate the project. So average accounting rate of return is calculated as average profits after tax divided by average investment. The question is, what is average profit? Average profit means you will add all what you make that year, maybe from year 1 to year 5. You add it together. Then you divide it by the numbers of what? By the numbers of years. Right? You divide it by the what? By the numbers of years. That will give you average profits. Average what? Are you noting it? Average profit. Now, then what is the average investment? I hope you guys are writing though. What is the average investment? Average investment, you can still check back. The YouTube is on YouTube already. So average investment is calculated as what? The initial investment, which means your capital outlay, your equipment, what you use to start the project, plus scrap value, the sales proceed, scrap value or sales proceed, right? Plus the working capital, if any, divided by 2. We give you what? The average what? The average investment. Now, class, what is the decision? The decision is that you have to accept the project if the average accounting rate of return is actually higher than the cost of capital. That is the cost of borrowing to invest in that particular project. What do? You accept it. You accept it. Means that you have more return. It means that you will maximize your shareholders' wealth after considering your what? The cost of borrowing. So we have the advantages and disadvantages. Now let's quickly move. Class. We've talked about the capital investment, capital budgeting or investment appraiser. We talk about capital investment decision. We've talked about the investment appraisal, where we have the traditional approach as well as the modern approach. Under the traditional, that does not consider the time value of money, that is where we have the payback period and the accounting rate of return. Then under the modern approach, that is where we have the net present value and internal rate of return. Class, I'm not supposed to stay long in this class because I'm actually under the weather, right? So you can see I'm not shouting too much. I'm just doing it small. So let's just take it like that, okay? Yeah, I'll be fine.
Sorry, sir.
Thank you. So we have the cash flow, the time value in investment analysis, right? So we are coming down to net present value now. Please pay attention to this part. For those who understand the relevant costing very well, your relevant costing will still be applicable here as well. So just do what? Just pay attention. This one is just English, I beg. Okay. Let's just start from somewhere. Okay, let me start from the beginning. Cash flow time value of money, investment analysis. Now, sound investment decisions should be based on cash flow and not profits, as it is cash that a firm can invest, pay to creditors, and distribute as dividend. Cash flow is simple and objectively defined concept, which is the difference between the money received and the paid. Class, you all can agree with me that cash is king, like it's king, right? Now, in accounting profit is, that is why when if that is why as an investment analyst or as a financial modeler, we don't use for accounting profits for decision. And that is why when we are doing a financial analysis on different matrices, accounting profit is subjective. We rather use a cash flow, a projected cash flow that we know, okay, although we are still projecting it that, okay, there is probability that it may not even occur, but there will be a chance by considering some kind of maybe some information, having some information, right? So cash is what is the king. So cash flow is actually different from what? From profits. Please. That is the bottom line of all this Turing here. Now, in net present value, when you want to determine your net present value under the modern technique, right? You need to consider your cash inflow and your cash outflow. First, your cash outflow must be relevant. So this is where relevant costing will play out here, right? Your cash outflow must be relevant for that project. If it is not relevant, you should not include it. Now, number one is opportunity cost. That is alternative forgone. Yes, the cost is very important because you are looking at it that if you undertake this project, either you undertake this project or they will give you this. Either you undertake this project. So you decide that you forgone what they will give you, then you go for the project. On going for the project, there is a law under the relevant costing that we say, okay, you look for the higher of the two. Look at it, which one makes sense. Is that not so? Now, the same thing applicable here. Your opportunity cost is as relevant as anything, right? It is always what? Always relevant. Now, financing cash flow. Your dividend, your preference shares, all these ones are not relevant. Do you know why? Because you've used all these preference share, dividend, you've used it to determine your cost of capital in discounting the project. And that is why the cost of capital is very important. Because sometimes the question will tell you that determine or evaluate the project using the net present value. Then the cost of capital may not be given to you, or the weighted average cost of capital may not be given to you. So you have to calculate the weighted average cost of capital using the same approach. But at this level, I think at this level, the cost of capital, either rail or money, all those things will get there, will be given to you. I think at this level, I can want to test your knowledge on real and nominal cash flow or cost of capital. We'll get there actually, right? So my point here is your preference dividend and all that are not relevant because you use them in determining your cost of capital that you will use to discount the project. Also, your working capital is also is as important as anything. What is working capital? What you use to run the business. At the beginning now, maybe when we started next gen, last diet, August, right? August. Then probably I used for the purpose of this class. Is that now? For the purpose of this class, maybe I use 50,000 for instance to start next gen. Then, as part of working capital, then other partners' contribution and all that. So, using 50,000 naira, it will be an outflow because it is what I will spend doing that project. Then, at the end of the project, meaning that maybe at the end of the diet, I will just say, okay, Mukona, give me my money. At the beginning, this is what I spend. At the end, so at the beginning of the project, it will become an outflow. That is year zero because you've not even started the project at all. Yes, we've not started next gen. I don't give, for instance, so for the purpose of this class, I've given maybe 50,000 naira for instance, right? 50,000 naira. That is at year zero. So at the end of the project, I will say, oh, I've spent this so amount. So I need to recoup back my investment. So that is the reason why most time you see working capital at the beginning will be at year zero, then at the end it will become an inflow. It will become an inflow because it is what in and out. It goes out and it comes in as well, right? So why is working capital treated as all these things? We'll look at them, but you just need to understand the concept. So why is working capital treated as cash flow? Why is it treated as cash flow inflow in the terminal year? Terminal year means that the last year. Terminal year means what? The last year. Now this is because actual cash flow will exist cash profit in the year, by the amount of reduction in working capital. Meaning that, let's just forget about the English, meaning that you've invested the 50 so that at least it will use it to reduce the cash flow, because you've expended 50,000. So at the end of the project, you take back your money. So it is in and out. So it will reduce the cash flow. So it is what you use to do what? To run the business. So another thing we need to talk about is material. Now, when material needed for a project, don't forget that I've moved to MPV now. These are the cash flow that we need, right? Don't forget that the financing costs, all those financing costs are not actually relevant here under the MPV, right? They are not what? They are not relevant. Don't worry, when you get to SFM, in SFM, there is a topic called adjusted present value. So all those things are relevant there too. Now, material. When material needed for a project, you have a material and it is needed for a particular project, is available in the company and has alternative uses. Is available. We need it for the project. For a project is available and also have alternative uses. You can use it for anything apart from the project. Now, what is the relevant cost? The relevant cost is the replacement cost. Class is the what? Is the replacement cost of that what? Of that material. Right now, when material are available, you have the material is available but has no alternative use. You can't use it for anything. The question is, what is the relevant cost? The relevant cost is the net realizable or the sellable value. The value you can sell that particular material when it does not have an alternative use. But where material is not available at all, you need to go and get exact material in the market. And what is the relevant cost? The relevant cost is the current cost, is the current purchase cost of the of the material. Class, are we still together?
Yes, sir. Yes, sir.
Yes, sir.
Yes, sir.
Yeah, thank you. Chini made a miracle. I'm seeing your hand. I hope it's not a mistake, right?
It's not a mistake. Oh. We passed
Wow.
opportunity cost, so I didn't get it whether it has to be added or minus, or whether it's relevant or irrelevant. Oh no, that's right.
Is the question is opportunity cost is relevant, whether it is cash inflow or cash outflow? Is the question that we say it is. Is it a cash inflow or cash outflow? Is it a cost or it becomes an inflow? Right? Some opportunity cost maybe okay. Let's say for instance now, the practical illustration is you're considering a project. They're saying that they will pay you if you go for this project, you will realize 50,000.
Okay.
Then if you did not go for this project, so you will realize 10,000. Right? You look for the higher of the two car. I have to go for this project. You forgot one, you move. So since it is what you will realize, it becomes an inflow. So it's the question that will determine whether it is inflow or whether it is outflow. We'll get there.
Thank you.
Thank you. So labor, when full-time workers do the job, salary, you may not even need most of all these things here. That is one thing about MPV. But let's see if I have such a question that I have. I think there are so many questions like that though. I'll check. So labor, when full-time workers do the job, salary paid to them is not relevant for decision making, right? Because it is their normal job. They pay me, it is normal, it's not relevant. But when it is casual workers, those people who do part-time, it is for a specific purpose. That is why you bring them now. Is that also? It is for a specific purpose. It is for a specific purpose. That is why you bring them to come and do what? To come and work. So the casual labor, their wages is actually what's relevant. Overtime, if you work overtime, only be relevant when it is paid on a specific project. It is for a specific project, of course, it will be relevant because it will be for that project. Variable overhead is always relevant unless stated otherwise. Unless what? Unless stated otherwise in the question. Then fixed overhead. Fixed overhead is not irrelevant. It's not relevant unless the examiner gives us the portion that is incremental. When you have an incremental fixed cost, so of course you consider it to be relevant, right? Attributable, specific, or relevant. Now, when it is an incremental fixed cost, it becomes a relevant cost. But anything that has to do with apportionment, of fixed costs, is not relevant. Apportionment of fixed costs is not an incremental. It does not vary. It is fixed. Whether you go for this project, you don't go for this project, you incur the costs. Right. So it is what it is. Let's move on to net present value. This is a discount cash flow. So we'll talk about the cash outflow that will be relevant or irrelevant, right? Now, the NPV, we should not forget that it's under the modern technique, right? So the NPV, this is a discounted cash flow technique that's explicitly recognize the time value of money. It considers the time value of money, right? And for the decision, if you calculate, they say, okay, evaluate the projects using NPV, net present value. So you base your decision. Now, if you have a positive NPV, it indicates that the projects are okay. Now let me just ask. I know most of you will have the knowledge of NPV though, right? I know, but let's quickly talk about when a project has a positive NPV, what is the decision? What is the decision that you know?
To
Yeah,
accept.
Okay,
Project.
to accept the project or to undertake the project. Is that not so? But in finance term, like if you want to speak to in finance term, you will not only say to accept the project, you will not add that the project will maximize the shareholders' worth. So therefore, AA Limited should accept the project. With that word, they will know that yes, you know what you are doing. It is not only to accept, it will maximize shareholders' wealth. Because shareholders will get a return on their investment on that particular project. Right? On that particular project. And we have steps. You identify the relevant cash flow, you discount it. Whether you are using real cost of capital or money cost of capital to discount the project, or as the case may be, the worst case scenario, maybe you need to calculate your weighted average cost of capital to discount the project. Then determine the present value, then the NPV. Right. So what is the interpretation? Is to accept a project that will maximize a shareholder's wealth. When it is negative, you reject the projects. So you can read up the advantage and disadvantages of MPV. So under the modern technique, we have the internal rate of return. Class, if you want to determine your MPV, you will know all these things. So let me just give you a clue. You already, I know you know all these things when we solve question. Though, let me just tell you something here. Your inflow, remove your inflow from your outflow. You have net cash flow. The money that comes in, the money that goes out, you have net cash flow. When you have net cash flow, you can charge tax. When you charge tax, you have the profit after the net cash flow. Is that also profit after the net cash flow? Then you discount using either the real cost of capital or the money cost of capital, or you calculate weighted average cost of, as the case may be in the question, right? The what else? You determine your MPV. We'll get there. So the next excuse me. The next thing you need to know is the internal rate of return. So when this class, so at exactly 10 p.m. please, 10 p.m. So in our next class, we look at calculations under all the techniques. Right, I think I have up to 20 questions. I think 15 to 20 questions. 15. APV about 5. The other one about 5. Okay, I think about 5 or 10 thereabouts. So as you solve, you have something to solve, right? Now, internal rate of return. What is the internal rate of return? The internal rate of return right? It is an assumption though, because a project that is positive, class, listen now. There was a time I applied for a role, and they gave a case scenario under the project finance, and in Excel, they bring their input, their index. When I say index, are what you will use to inflate your cost, your cost price, your selling price, your all those things. They put it there, the percentage that it will increase and all that. So I calculated the project, I read the case, I analyzed it, put it there. I have a negative MPV, but the internal rate of return given to me in the question, they gave a positive internal rate of return. I look at it, I check, actually, could it be that my calculation is actually wrong? Could it be that my interpretation is wrong? I go back to the interpretation again. I interpreted the question again. I say, no, my interpretation is, I'm correct. This makes sense. Then later, after I submitted this thing, so I realized that it's for my calculation. But then, lesson to learn. When they give you internal rate of return in anywhere, in any test, definitely the MPV is positive. Plus, the MPV is positive. They can never give you a project that is not viable. Why? You can't calculate it. You can't even calculate the internal rate of return without a positive MPV. So that is it. It is not possible. So it was later like, okay. a lesson to learn. So, you have to go back to research and say, oh, it's not supposed to be like this. We had a lot of during the interview, like a lot of back and forth. This is that, this is that, this is that. So please, when you have a internal rate of return, definitely your NPV is positive because you can calculate internal rate of return without a positive NPV. Practically, right? So if you want to determine the internal rate of return, right, we already know this. Internal rate of return is the return on investment for what? For the shareholder, for investors, actually, for investors. Now, what is the decision? Internal rate of return is part of the modern techniques, right? If your internal rate of return, if you have internal rate of return of 2% and cost of capital, when I say cost of capital, we know now cost of borrowing is internal rate of return is 2%, then cost of borrowing is 10%. The project is not viable because your internal rate of return is less than your return is less than the cost of borrowing. It's less than what? The cost of borrowing. That is the reason why you can't treat investment appraiser without having an understanding of cost of capital. There is no how you will treat, we will take what is this called? Valuation of a business without having an understanding of cost of capital. So cost of capital is like a bedrock. You can't do without it. Please, if you don't understand cost of capital, don't even bother to go and write the exam. Do you know why? And some of you will think, no, now should be I get investment. Inside that investment appraiser, there is still cost of capital. Whether it is real or nominal. Right. Now, if your internal rate of return is less than the cost of capital, the project will not be accepted. They will not accept it because it will not maximize the shareholders' wealth. But when the internal rate of return, the percentage is greater than the cost of capital, so let's accept the projects. It makes sense. It's what? It makes sense. So we move again. You never finish. Advantages, disadvantages. Okay. Oh, modified internal rate of return. This one is not covered in your syllabus, though. Please, can what? Is your network, Fikayo? It's actually your network. My network is always good now. Right? My network is always good. So, modified internal rate of return is not for your level. I think it's not for your level, but if I see a question that we need to do about it, I'll bring it on board. Right? I will do what? I'll bring it on board. Yeah, with that. Who is that? Yeah, I'm with you. Yeah, good evening.
Go ahead, sir. Go ahead.
I should go ahead for.
You said that MIR is not for it's for SFL. I said you should go
Yes,
ahead with the class.
okay. Okay. Leave profitability index, okay? when we get to capital rationing, you do that one, okay? Trust me now. I will cover what it is, what I have to cover on the investment appraiser. I think that one modified internal rate of return is not part of the listing. Right? I don't know. I just added everything. So let's quickly round all our discussion. Let me quickly do a summary before I move to this part. Please, if you have been chatting with your, and you just have to just put it on hold, because all those ones that we've been explaining, at least it makes sense, and but this particular side here now, you just have to concentrate, okay?
So I don't understand. Though.
You don't understand? Okay. You understand, don't worry. So class, we've talked about the capital budgeting, which is investment appraiser. We have the model, we have the capital investment decision, where we have the mutually exclusive, dependent, independent, divisible, indivisible projects. Then we have the investment appraiser, the traditional approach, the modern technique, the traditional approach, the payback period, the accounting rate of return, the modern technique, the MPV, and the internal rate of return. Now, we need to talk about inflation in capital investment or investment decision. Now, you and I can agree with me that when you want to do a project, right? You want to embark on a project. You are forecasting for, you are expecting something in the future. Now, in the expectation of what will happen in the future, you have to consider what we call inflation, whether it is general or whether it is what specific. But now, let's quickly talk about inflation. I hope you guys understand my explanation there. You want to embark on the project will last for 5 years. Then, as a project finance officer, as a financial planning analyst, or as anything, then you are looking at it. Okay, the future expectation of future cash flow must include inflation. Must include what? Inflation. Class. Now you need to adjust for inflation in that case. Now, what is inflation? Inflation is a change in our prices, right? It's a persistent change in the prices of goods and we know what's so we know what's what is it called? When there is a changes in the price, we talk about inflation. So as a financial expert, you need to consider the inflation, that is what will happen in the future. Now, types of inflation. Types of what? Inflation. Now, for the purpose of project appraisal, it is necessary to distinguish between the two types of inflation. The general, you just need to know it. It is not that they will tell you that this is, but you just need to know it. Oh, excuse me. So you just need to know it. The question is, what is general inflation? General inflation is when they will give you in a question. All my thing is I would always refer to question. Yes, so that you understand it. Now, general inflation means that they give you in a question that the inflation for this, for all the for all the cash inflow and cash outflow is 5%. Is 5%. All true. That is uniform. Your selling price should be 5%, your this should be 5%, your this, everything, or they give you a certain percentage that okay, this is they have a general inflation of 10%. That is all the whole cash inflow and cash outflow use that 5% for them for the inflation rate. Class. That is what we call general inflation when there is a uniform in the inflation rates. Then what is specific inflation? When you see in the question whereby they will tell you that selling price will increase by 5%, variable cost will increase by 6%. Which other one? Fixed costs will increase by 10%. That is specific to all these variables. Class, they are specific for the variables. Right? You can see 6% for selling price, 5% for this, 2% for this, and 2% for this. Now, the existence of more than one inflation rate in a question is an indicator. Is an indicator. Let me highlight it. The last one here. Can you see it? I will end this class with money cash flow, real cash flow, blah, blah, blah. So when we come back, we know we'll just do a revision, 5-minute revision, recap on all those things. Then we'll move to solving of questions, right? Now, the existence of more than one inflation rate in a question is an indicator of specific inflation. Selling price 2%, variable cost will increase by 5%. This will increase. That is what we call specific inflation. Okay, types of cash flow. Now, please, class, pay attention. Oh, you see this part? This is another problematic, right? Under investment appraiser, and it's very, very simple. Like very, very simple. We have different type of cash flow. We have what we call the money cash flow and the real cash flow. I'm scaring you. No. Which is this one now? Abba, no. Is it Uzena or what? Uzena, right? I'm not scaring you, please. No. That is not, please, I'm sorry about that, please. No, that's why I say it's very simple, honestly. I'm sorry about that. It's very, very simple. You get, so you don't need to be worried about it, please. Thank you. Now, types of cash flow. There's what we call money cash flow and real cash flow. Now, the question is, what is money cash flow? When in a question, the actual amount of cash flow used in transaction, that is cash flows in nominal term, they are inflated cash flows. What does that mean? A money cash flow or nominal, it is also known as nominal cash flow. A cash flow that have been inflated. They are inflated cash flows. What does that mean? It means that they've considered inflation. I give you 15 naira today, and I'll tell you that what is the current inflation rate? What is the current inflation rate? What is the current inflation rate? Should be now they use ChatGPT. Where? What is the current inflation rate? Okay.
It's around
4%.
27 to 30.
Eh? It's around what? You want to kill us? Now CBN no carry rate go 30%. If it is thank you, 21.6. If it is around 27, away. So that is 21.6%. Right. So if I give you 15 naira today, the 15 naira I gave you, does it factor in inflation? Of course, it is. But in another case scenario, we'll get there. But my point here is you should understand that a money cash flow or nominal cash flow are cash flow that have inflation, that has been inflated. A cash flow that include inflation. If I pay you salary today, if I receive salary today, for those who they receive salary, let's say 20 naira, right? 20,000. Do you know why I say for those who are receiving salary? I've not started. So maybe 20,000. And that 20,000 naira you receive as salary, has it been inflated? Class, the 20,000 naira, has it been inflated? Does it include inflation? Class, you pay me salary of 20,000. Now, have you factored in inflation in that salary? You pay me.
No,
No,
sir.
sir.
No, sir. No. No, sir.
Thank you. That's fine. Please mute your mic. So, meaning that if you have not factored in inflation, that make it to be what we call real cash flow. Because you've not considered inflation without the effect of inflation. So in every question, you will watch out. If they say selling price will increase by 5%, inflation will increase by 6%, those cash flow, as you are increasing them, they have become money cash flow. And if you have a money cash flow, you must use money cost of capital to discount the project. Oh, this is 10:03 away. Wow, this is 10:03, right? And I say it's 10 p.m., right? So let me just round this up. Right? Now, money cash flow, you have considered inflation. They say selling price will increase by 5%, variable cost will increase by 6%. You inflated them, those variables. That cash flow that you arrive at as you are inflating them, it is what we call a money cash flow. And that money cash flow must be discounted with the money cost of capital. But when you have in a question real cash flow, that is the current terms, the current price that is yet to consider inflation, and they did not say you should inflate it. They just give you the cash flow. They didn't tell you that you should inflate it. Now, if you have a real cash flow we goes with real cost of capital. Money cash flow we goes with money cost of capital. Real cash flow we goes with what? We goes with real cost of capital. The 20,000 naira salary I received today, it is a real cash flow. Someone will be receiving, maybe collecting 50,000 on a month-on-month basis. I the money, okay, 50,000. Take the effect of inflation of 21.6 from 50,000. In your real term, yes, you are any more now. 50,000 makes sense in real term, but in money term, in nominal term, in money term, you are not receiving 50,000 naira. On this note, I think we'll continue from where we stop. Yeah, I think I have to go. This is 10:06. Like I said, I'm actually under the weather. I would have loved to complete this, but then I have to go. So, professional colleagues, I think I've been able to do justice to some extent, right? To this part. We'll continue from this part in our next class, right? So, money cash flow goes with money cost of capital. Real cash flow goes with real cost of capital, right? Then the question now is, how do we determine money? Thank you so much. How do we determine money cost of capital? How do we determine real cost of capital? Class, let me leave all this to our next class. Right, let me leave all this to our next class.
Thank you, sir. Thank you, sir. You tried. Thank you, sir.
Thank you very much. Thank you.
So when we meet in our next
Very, very
class,
much.
Thank you so much, sir.
Right? Well, thank you. We'll unlock everything. So you don't need to be scared about, you see, FM, anything, any courses we are taking at next gen. Any topic we are taking, like any courses, like just know that it is gone. With your consistency, and you get your material and you're consistent with lecture, believe me, you don't need to be scared about anything. You're good to go. Right? Just believe in yourself. And don't forget, grace does not work in an isolation. Grace does not work in an isolation. You must work for it. Effort. I'm supposed to take a rest. Like, even other partners, they will say, IB, no. I say, no. I have to take this class because it is very, very important. We don't have much time again. Right? So please, make sure you go back to the YouTube. It's there. Just go back again. The material will not be available now or maybe until next class because I have to look at it. Let me show you guys what I've done. Right, so I have a lot of questions here. Can you see them? I have a lot of questions on this. I have a lot of questions. So I'm just arranging them, right, from other relevant source, ACCA, I can, as well as other tests as well. So imagine all the materials together, right? So, Heritage, do you have question for me before we go?
No, sir, it's not on today's topic, sir.
Okay, what is it?
Okay, is on the assignment.
Mm,
I wasn't able to. The working I did, I felt it was not correct, so I didn't share it. So I wanted to find out. I know in previous lesson you taught us that when loan notes are redeemable, that we should use the same IRR formula. But I now noticed that some of the items that are some of the ingredients, as you usually call them, that are supposed to be available were not available. So I lost track.
it is not possible that all those ingredients will not be available. If you have identified the right sources of finance, definitely. Is it the Inca PLC?
Yes, sir.
Uh, and what do you want to calculate first? What do you want to calculate? I
The-
don't even forget the question. Let me stop the streaming first.
Okay,
Come.
sir.
Okay. I'm listening. What do you want to